Howdy folks, Jeff Camarda. It is Thursday, May 21st, just 1 month before the illustrious summer solstice, the longest day of the year and close to the midpoint of the year. And it really is just amazing how quickly this year has slipped away in such a surreal way. With all the great the gulfs of social distance and kind of cloistered most of us in our homes, but away it goes. In any event, from a market standpoint, not a whole lot to report. Another notionally down day on the U.S. markets. Not a whole lot. Again, we're just trapped. Last week was down a lot. We've recaptured a lot of last week's losses this week, but it's still very stuck. Not even in the trading range. It's kind of compressed up against this resistance level. And knocking on the door but not busting through, which in my view is kind of a bad sign of a significant down leg to come. We'll just see. Either way, we're locked and loaded for what to do when we do see a significant market move, as illustrated in the past couple of videos, so I won't bore you with repeating that now. One thing I do want to talk a little bit, give you a financial planning tidbit, talk a bit about life insurance. We've been doing a lot of work with some new doctor clients that were referred to us from some of the recent webinars that we've done. And life insurance comes up a lot. And the first thing I want to underscore, I say this as a reformed commission life insurance salesman who spent most of the 90s working for big insurance companies and selling life insurance, that life insurance really ain't an investment. It's often spun that way. We're trained to spin it that way as a way to move bigger policies, cash value policies, but it's usually not a good idea. It's far more complicated than what the numbers on the illustration, the cash value projections would indicate. For instance, there's a fellow, I won't mention the company name, that I'm talking to that said, gee whiz, my whole life product, look at that, it's providing 4.5%, which is better than bonds these days, so folks, investors should buy it. And when we peel back the cover and look at all of the disclosures and the actual calculations, the rate of return is negative for several years. And if you hang on to the thing for 30, 40 years, and if they pay what they're paying now, which is based on the old money rates, which they probably won't going into this near zero or maybe negative interest rate environment, if all of those things are true and you keep it for a long time, then the payout, whether the rate of return be close to 4%, but it's a lot more complicated. Anyway, the short of it is, in my view, in my well-studied view, life insurance serves a specific purpose, and that's to replace income if a breadwinner dies before retirement, before the family has accumulated enough assets for both spouses, hopefully, or one spouse to get by without being pinched because an income is gone. And that's really the definition of term insurance, a specific term. My insurance, I got a lot of insurance, but it's going to run out in a few years, and I don't really need it anymore. We've accumulated enough assets that Kim can probably scrape by, on what we have, or the kids can. And that's really how I want you to look at insurance. So many of our clients, many of you watching this evening, are retired. And absent using it for estate planning or estate tax purposes, which is something you should look at, especially with the laws that we've seen change over the past 10 or 15 years and a bunch of other things. And there's one person in particular I'm speaking to that I know you're watching, that you want to get an in-force illustration of those policies and take a look at what the trajectory looks like going forward and make sure it's still a good use of your family's resources. But again, estate planning and estate tax planning aside, most folks don't need insurance past the age of retirement. And those of you that have policies, particularly cash value policies, and I mean just regular ones, not that are in a special irrevocable life insurance trust for estate planning purposes, want to take a look to see if you're better off converting those cash values to additional retirement funds because the need for insurance has passed. And I thought about this afternoon as a simple analogy. Say that you want to drive across the country from New York, say, to California. And by definition, you need to drive, so you're going to be in a motor vehicle. Well, you need a car to do that. You should buy the car or rent the car. But once you have traversed the continents and you're looking at the hopefully placid Pacific Ocean, and you're staying there, you don't need a car no more. It served its purpose, and life insurance is really like that, to cover a need for a specific period. And once a need has passed, don't cling to it. A lot of people hang on to it for just kind of out of habit, or because the insurance company, insurance agent doesn't want you to get rid of it because it's profitable for the agent and the insurance company. But you need to look at what's important to you. Okay, so I'm going to go ahead and kick this life insurance soapbox out from underneath my feet. Hopefully I won't hang and on my comments. And until tomorrow, until Friday the 22nd, one day closer to the solstice, I wish you all wonderful, merry, placid, peaceful, and lovely evenings. And hopefully we'll have good news tomorrow, and look forward to moving into a cheery holiday weekend. Thanks you all for watching. Talk to you tomorrow. Bye-bye.